I probably should sort of slightly reframe the title here, as Sam made the point. I mean, active versus passive has to some extent been done to death, and I think it will keep on being done to death for a very long period of time. Neither is about to disappear, and in fact, in many cases, both of them have a place in the broader portfolio construction question. The way I would sort of reframe what I wanted to talk about today, frankly, is the danger of cheap and dumb investing. And really where I'm coming from is two broad points. One, just thinking about some of the economic impacts of the investing decisions that we make, and when lots and lots of people start to do the same things, what sorts of effects does that create in markets? And I want to address that really in two ways. Firstly, in a pure economic sort of capital allocation context, and then the second one in a sustainability and governance implications context. And then the third thing I wanted to do was actually just come back to the question that Sam asked at the start and provide a sort of a different dimension to that question. But firstly, I suppose, and you know, given that I work for an active manager and we all have to put up disclaimers every time we talk about, in fact, pretty much anything, then this was my disclaimer, which is this is not about sour grapes. So as an active manager, this is not me sitting here saying, you know, you're all wrong, everyone who's going passive, because you're harming my business. In fact, much more broadly, what I wanted to hopefully convey was, and it was sort of, you know, made a topic made famous really by John Maynard Keynes, where he talked about the paradox of thrift. And he wasn't the inventor of that topic; it was actually invented, or that concept actually sort of arose in the 1700s. But he was the one who publicised it, and therefore generally gets the glory. But the concept behind paradox of thrift, which is clearly, you know, and particularly with all of us working broadly in the savings industry. If people save more individually, that's a good thing. But in aggregate, if everyone saves more, then that can be bad for the economy because it drives down consumption and investment and so forth. And given that it's a closed system, if we have a greater level of saving, that'll actually lead to a falling level of saving. And that really gets me to, I think, the point that we need to be aware of whenever we're thinking about issues in finance, and it's really if there was one phrase that I think sums up you know, what to think about and what to be wary of in financial markets, it was this one, and that's basically when nothing bad happens when small numbers of people do something. We run fairly big liquid markets globally. If only a small number of people do something, it doesn't really create major issues. But when everyone starts doing something, then the potential is for all hell to break loose, because that's what creates major bubbles and distortions in markets. And we're starting to see, I guess, already some of the, you know, the press is starting to pick up on some of the issues, particularly around the way in which flows into not so much passive, but what I would start to term quasi-passive vehicles has started to build up. And this is actually a fairly large sums of money that are now moving into these types of vehicles. This is a chart that just looks at sort of through to early 2017, the flows into passive and out of active managers. And passive here is represented as basically ETF and passive mutual funds. And those two numbers, 2.1 trillion out of active and 2.1 trillion into active, are you know, not insignificant, even given the size of global markets. And in fact, through the first 7 months of this year, the flows into passive ETF vehicles already exceeded the total flows for last year. So this is a trend that has been broadly accelerating. And the issue that we think about when we look at it is, well, what are the distortions created by these flows? So in a simple world, if we had all of the money that was flowing into passive vehicles was flowing into a broad market cap-based index, then we don't end up with too many distortions. The aggregate market may rise or become in aggregate distorted versus other asset classes, but you don't create internal distortions if you're broadly just following along market cap lines. The problem starts to arise when we start creating subsectors or sub-indices or sub-asset class categories, and flows into those asset class categories, you know, be they passive or indeed even inactive in some cases, are far outweigh the underlying market cap of those individual subsectors. And so what we did was conduct some analysis where we said, all right, let's add up for all of the ETFs that are out there, let's look through each of them and understand, well, all right, what's the dollar-weighted value of all of the stocks in those ETFs? And then let's add up all of those dollar weights and compare it back with the market cap weights, and what do we get? Is that broadly similar to the market cap weights, or is it somewhat different? And that'll give us a sense as to what degree historically money might have flowed into passive type vehicles and quasi-passive vehicles and overly distorted the underlying market caps. And then the second thing we did was then look at sort of more recent flow data and weight again each of the flows within all of the ETFs by the dollars of flow money that was coming in or out of those vehicles, and try and again compare that back with the market cap. And looking across the top 10 stocks in the S&P 500, this is what we found. So on a flow-weighted basis, every single one of those stocks was receiving a greater proportion of its daily flow than its market cap would suggest. So very clearly, the flows that are going into these vehicles are overhyping those, at least certainly the top 10 stocks, and that must clearly be offset by stocks further down the market cap spectrum, which are getting gradually underweighted. And then we saw the same thing when we started to look on a weight basis. So every single one of those stocks is broadly receiving somewhere between 120 and up to 150% of what its market cap-based flow should get, because of all of this money that is broadly piling into these sorts of vehicles. And in fact, if I just wanted to pick on one of those, if I just pick on something like Amazon, which you could spark a fairly heated debate as to whether they're about to take over the retail sector around the world or not. But just looking at Amazon in particular and looking at the flows, so the owner of Amazon, Jeff Bezos, in the last 12 months has sold out $2 billion worth of stock. If I take the top 10 shareholders on the register and look at the active managers on that register, they've sold out $8 billion worth of stock, and the passive managers on that register have bought $6 billion worth of stock. So there's very clearly been a large skew. The passive flows are the ones that are buying, and obviously that doesn't add up to zero. So the difference is probably being made up by much smaller investors, and I think particularly individual investors who have been following the momentum that's flowing through from that stock. So there's very clearly been a market cap distortion that is flowing through when we start to look at these flows that come through. And in fact, it's interesting, a number of studies have started to come out. Deutsche Bank produced a paper a couple of months ago where they said, well, look, passive isn't that bad because in aggregate it really only represents probably about 20 or 23% of the stock of assets across the marketplace, so that's not particularly large and it can go a lot further. Our view is that it's not stock that counts, it's flow, and when you look at these flow statistics, the flows are very clearly becoming distortionary. So if you're a buy and hold investor, that's not such a, buying and holding doesn't really affect the price, but when you've got money moving in or out, that really does have an impact on the price. And when we look at the money flows that are going on through some of these ETFs, they are quite clearly not buy and hold. So the largest ETF in the world is the S&P 500 SPDR. That does about $16 billion a day in flow, which represents about 6% of its total value. So every day, 6% of that ETF is turning over. The second biggest ETF by flows in the world is the PowerShares QQQ. That's the NASDAQ 100 ETF. Again, so that's a subsector index which is driving a number of these particular stocks. That has flow figures of $5 billion a day and a rough turnover number of about 7% a day. So over the course of a few weeks, these things are turning over 100%. So there's an awful lot of flow that's going on underneath here. As an interesting sort of sidebar, the seventh largest ETF by flows is something, and I have to write this down because I can never quite remember the full name. It's called the Velocity Shares Daily Inverse VIX Short-Term ETN. And if you can tell me what that is, you're doing well. But that thing turns over $1 billion a day, or roughly 150% of its market cap. So if you're looking for potential distortions that are being created by investors attempting to buy what they think are simple, relatively cheap exposures without necessarily understanding what those exposures are, there's a classic example. So distortions are certainly being created, in our view, on an economic basis. The second area where we potentially see distortions is around sustainability and governance. A little cartoon here about pay rises. But I think it's quite interesting. There's a piece of research which is still a working paper, but it's been published from the European Corporate Governance Institute, and they looked at what was the remuneration outcomes across the marketplace. And in particular, they were comparing the remuneration outcomes of companies that they refer to as broadly held, i.e. largely kind of owned by passive-based investors, versus the remuneration outcomes of less broadly held companies. And their results were that it was a statistically significant result, but on average, the pay given to broadly diversified companies with broadly diversified holdings was nearly $900,000 per year higher for the executives than it was for non-broadly diversified. So clearly there is an issue in terms of the voting and corporate governance. And while that, maybe getting better, if we look at the voting records of some of the biggest, mostly passive managers around the world, they've gradually been stepping up, one, their engagement, and two, the rate at which they are voting against corporate management. But it still sits in the order of 92-93% in favour of management every time. So I think there is a distortion as these flows become larger and larger, or those weights become larger and larger. And certainly if we look at, again, those same top 10 holdings, what percentage of the top 10 holders are actually passive, and very, very large proportions of these companies now have top 10 holders which are largely passive-based managers. And again, the corporate governance, while it's improving, is still not necessarily as strong as what it would be when you can vote with your feet. If you can say, I'm taking my capital away, that tends to have a bigger impact on management than not. So I think sort of distortions from both a corporate governance perspective, sustainability perspective, as well as a price level distortions are some of the things that we have to be careful of. So coming back to, I guess, addressing then Sam's points around, does this create opportunities for active managers? Well, firstly, a little sidebar on the active versus passive debate. One of the bits of data that is used quite heavily is something called the Spiva methodology, which looks at what percentage of managers, of active managers, have underperformed the index. We've got a paper that's about to come out where we've looked at that, but reclassified the data because there's a few issues in the way that Spiva do their analysis. And just sort of very simply, if you take the Spiva results, that is the percentage there, the blue bar represents what percentage of managers have underperformed their index. If we now start to adjust for a number of things, firstly, Spiva don't use the actual fund benchmarks, they use a standardised benchmark across everyone. That makes a bit of a difference. If you then adjust for survivorship bias, particularly around closed funds, that makes a bit more of a difference. And then if we adjust for new funds that might have started within the data period, that makes a bigger difference. So for a start, and this is maybe a little bit of sour grapes, a lot of the data that gets represented out there is a little bit misinformed. And I think, that debate about active versus passive, as I said, will be one that carries on for a very long period of time. Ultimately, to my mind, it's a debate that's about price, and as long as active can justify the price that it's charged, bearing in mind that anyone who is not passive is by definition active, and active we can split into professional and non-professional, then as long as the professional active can justify the price that it charges relative to the performance it delivers, then I think active will continue to survive most certainly. But the last thing I wanted to just touch on was back to Sam's point. Does all of this distortion that we've just talked about create opportunities for active managers? Well, it does and it doesn't. It does create an opportunity down the track, but it only creates an opportunity to the extent that you're willing to hold on to realise the opportunity. And an interesting bit of analysis, and this is in fact some work that was done by Vanguard in the US, started off by saying, well, let's take the universe of active managers have outperformed over 15 years, so highly successful active managers over a long period of time, and then let's look through that, and in that 15-year period, how many of those managers outperformed every year, and he outperformed 14 of those years, and so forth. And actually what the little distribution there shows you is that virtually none of the managers out of that 15-year period had less than 4 years of underperformance. And in fact, on average, those managers, to be that successful, had to almost underperform for a period of 7 years out of those 15, not necessarily consecutively, but 7 of those 15 years of underperformance in order to generate a very positive active result. So the behavioural biases that we all exhibit in terms of hiring and firing can quite significantly play into, whether or not you can realise those opportunities from these distortions. Thank you very much.
Let the cage fight begin. No, I'll save that for questions. I'll be very mature in my presentation part. But I'll start with sharing with you that approximately 80% of New Year's resolutions don't make it past the first week of February, which makes me feel a little better about being here. Because when I accepted the kind offer to join Vanguard earlier this year, after almost 10 years of being a client, I made a resolution to myself that I would never get caught up in the indexing active argument. And here I am. So I'll share with you why I made my failed resolution. Firstly, because getting caught up in the indexing active argument is a mug's game, whichever side of the debate you're on. Vanguard launched its first index fund in 1976. Any debate that continues in academic journals and industry forums 40 years later is not going to be resolved in 50 minutes on the Gold Coast. No matter how Greg and I might cut and dice the data and argue persuasively against a backdrop of charts and performance tables, most of you will walk out holding the same investment beliefs that you walked in with, because that's what they are, investment beliefs. The second reason I made the resolution was because I actually joined Vanguard at a time when it's expanding its offering in Australia from just indexing to include active. Not a lot of people realise this, but Vanguard actually launched its first active fund before its first index fund and manages more than $1 trillion in active money globally. For us, indexing and active are just more tools in the toolbox, all part of, just realised I should click, our core purpose of giving investors the best chance for investment success. So why do people persist in arguing the indexing active argument? Well, looking at incentives is always the best place to start. Clearly, there are business models that rest on convincing investors for either indexing or active. So that's a dollar motivation for many to keep the debate live. It's not one that motivates us at Vanguard because we're actually owned by our investors through a mutual structure that means all our profit goes back to investors through lower fees. Another behavioural reason for why the debate continues to draw people in is, I think, a quite natural desire that everyone wants to be on the side of the angels. And it is true that the pro-indexing camp does exhibit a certain missionary zeal and does relish painting active managers as fallen angels who started off with good intentions but then got caught up with hubris and the lure of revenue-driven asset gathering. Now, it used to be that the active rebuttal was that indexes were too angelic. We were too idealistic, too theoretical. Now the attack tends to be that we're too big, too lazy, and my personal favourite, threatening the very future of capitalism. Now, You will have heard both sides of the debate so many times before. So even if Greg and I did make it an entertaining battle of the sexes, all it would do would be challenging your investment beliefs. It wouldn't provide you as trustees a useful takeaway. So I'm going to switch from faith to frameworks to hopefully give you a more useful way of looking at indexing active. So the first framework is captured in a very neat decision flow chart. So the starting question is not whether indexing or active is good or bad. It's actually a question about your own fund. Does it have the resources and expertise necessary to identify outperforming managers? And those resources might be internal or supplemented by your asset consultant. So the first step is therefore binary, yes or no, move accordingly. No takes you to 100% indexed. Yes takes you to manager searches and due diligence. After that, the framework comes to play with some of the inputs of your gross alpha expectations, costs, remembering that costs are far easier to predict than alpha, your active risk, and then finally, your fund's active risk tolerance. So the trade-off becomes for an investor between their subjective alpha expectations and their subjective assessment of their tolerance for risk, particularly on the downside. And that's actually at the heart of the indexing active decision. So it's not an either or, but it's really about a mix that is appropriate for your fund to achieve your objectives. And that shapes both the distribution of outcomes, the shape in terms of narrow or wider, and then can shift it depending on the mix. Now, naturally, as an investment house with a big research department, we took what sounds a very intuitive framework and we turned it into an optimisation that maximises utility-adjusted wealth. Now, I am very happy to provide people with research papers if they want to see me afterwards, but Dr. Sicilia aside, I actually think it's easier to think of it this way. Think about the ability to identify talent, being able to access that at a low relative cost, and having patience amid the inconsistency of alpha. Now, this actually aligns very well with another framework, which is a budgeting framework that I found very useful as CIO of a very little industry fund over the past few years. And what are our budgets? Risk, liquidity, fees, and we know that it's net returns that drive outcomes for members, but the reality is your funds are operating in an environment of choice that has a spotlight on fees that will only get more intense in an RG97 world. So our budgets: risk, liquidity, fees, and governance, which is the resources and the capability to oversee decision-making and the organisational understanding to have the patience to stay the course to see longer-term performance. So I find the mix of those budgets help determine often what asset classes you invest in, and the mix of indexing and active that is appropriate for your fund given your budgets. Now, you may have noticed I've couched, or you may not have noticed, I'll point it out to you, that I've couched this discussion in terms of active indexing, not the forum title, which is active passive. I try and avoid the word passive in this context because when I go to level 28 at Freshwater Place, where all our portfolio managers and traders are locked away, there is no sign of passivity. They are busy with the myriad of decisions that are required to manage index portfolios. Decisions which centre around the index's dilemma of that trade-off between tracking error and transaction costs incurred as a result of turnover. Now, a lot of that activity is not very exciting. A focus on corporate actions and cash flows does not make for colourful conversations, but it does make for very tightly risk-controlled and cost-controlled portfolios. Trading is a little more colourful. And ironically, trading at many active managers is actually very passive. Just get the trade done. If you think it's a multi-bagger, a big alpha promise can hide a multitude of explicit and implicit costs. For indexes, there is nowhere to hide. And so there's a lot of decisions to be made in how we implement and manage portfolios. Looking for crossing opportunities, accessing liquidity through different channels and exchanges, protecting the information in trade intentions, selecting the best algorithms and timeframes for execution, passing trades between our regional offices to benefit from local market expertise. All a lot of activeness. But let's not lose sight of the forest for the trees here. All that activity within indexing helps our clients, but it is all at a micro level. And I think any discussion about active indexing should acknowledge that the most important decision for your fund is the strategic asset allocation decision, and that is always active. It can be, once it's decided, it can be static or dynamic, can be implemented through indexing or active or mixes of it, but it's always worth keeping in mind that the most important decision is active. So in our minds, indexing active is not a debate, it's a decision, and best made within a framework that recognises the challenge of identifying and achieving persistent outperformance. However, as this 40-year-old image shows, history does not repeat, but it does rhyme. There will always be people incentivised to attack indexing. But the sensible investor recognises that the indexing active decision is about getting the right mix to deliver good outcomes to the members of your fund. Thank you. Now we take the gloves off.
Boy. Okay, I'm sure you'll agree that that was no ordinary active-passive debate. Is there any questions from the audience before we launch into the plethora of 15 or more questions that have been submitted through the app? Anybody want to go first? Here's your opportunity. Okay, let's start with the app questions. First question, I think first question is probably directed at both speakers. The question is passive investing just for funds that are poor at picking active managers?
Ladies first. Well, no. And I guess I could say at the outset, I mean, much as probably came through in the discussion from both Mary and myself, I mean, we're certainly not anti-passive per se. There is always a place for understanding what exposures you have and then trying to acquire those exposures as cheaply as possible. We use passive management in some of our strategies for various bits and pieces where we think it makes sense. The key point is understanding why we're doing it and what it is we're buying, and making sure that what we're really looking for is just the cheapest possible implementation of whatever is ultimately an active decision.
And I come back to the budgeting frameworks about, it's not just, you don't use indexing just because you're not good at picking active managers, though that is incredibly challenging and made more difficult by the fact that active managers have overpromised and underdelivered for years. But if you think of it from a budgeting framework, how do you use your fee budget? You may actually want to, index a certain part so that you can go far more active in another asset class. You're split between real assets and listed assets. How you use your risk budget, your fee budget, your governance budget, they will help determine what the mix between indexing and active is.
Okay, a follow-up question. There's a couple of questions that were linking to the effects on the market. The question here is the rise of passive and ETFs, or with the rise of passive and ETFs, do the boards and management of listed companies become less accountable?
Well, I think that's where the European Corporate Governance Institute paper was quite revealing. Again, coming back to that study, when they looked across the remuneration outcomes for all listed companies, and I think it was based on S&P 500, they did an analysis to see for those companies that had basically larger passive holders, what were the remuneration outcomes of the chief executives, or the whole executive team, actually, not just the chief executives, versus those which had much less passive ownership. And there was a statistically significant bias for the management of those companies to get paid more. Now, the rationale that they used, which we could debate and you can choose to agree with or disagree with, was that in a passive context, the real objective of the economic objective of the passive manager is for the overall market the whole sector basically to perform rather than any one particular company. Whereas for much more narrowly held companies, i.e. those that have a far more sort of active shareholder base, if you like, then they clearly want their company to do better than any other company, and therefore they reward management accordingly. And in aggregate, if you just reward everyone sort of equally as well, it generates a higher aggregate remuneration. That was their analysis.
I haven't seen the exact study, but my response would be, I hope we're not confusing correlation with causality.
The thing... Go.
Okay. This, when I said about the active rebuttal now tends to be we're too big, we're too lazy, we're threatening the future of capitalism. That fits into the too lazy category. And it is true, we are, and like a lot of large funds, facing the same challenge of how to approach governance when you are a universal owner. We are long-term investors in most of the companies that we invest in. And our investors have long-term objectives. So we're not activists who are going to move our money away. So therefore we've had to face that challenge of what do you do to improve governance? Clearly we vote. We also have programs of engagement, which we used to be very, I'd say, discreet about, keep it very low profile, as part of our view that would help build trust and confidence in the discussions we would have with management of senior management of companies and boards. We've decided in the last year that we actually need to be more public about that, and we have, again, as well as the research paper, I'd be happy to share our investment stewardship report. Last year we had engagement, apart from voting for thousands and thousands of proposals, we actually have an engagement program where we had engagements with, I think it was 954, it's 900 and something, and that had just continues, it goes up, for the last few years it's been going up about 17% or so a year. So we focus a lot on governance, that's our key driver, is that we think, and particularly on the composition of boards, on the disclosure by boards. When you are a very large investor, we can have meetings, every board and CEO will meet with Vanguard. And that allows us to have discussions with them about the kind of our concerns and to understand their reasoning as well, and to have discussions. Ideally, you don't have Ideally, things never get to the stage where you vote against the board proposal because you've had those discussions beforehand.
Well, and the statistics are that if I take the top 3 passive managers in the US, at the moment they vote in line with company management between 92 and 94% of the time. And while that shouldn't necessarily be the sole statistical measure for the reasons that Mary's just outlined, where upfront engagement is better than necessarily just voting against, I think that to us is a pretty clear indication as to what degree that active engagement is actually having a positive impact. And if you think that 92 to 94% of all executives are doing a good job, then that's a good outcome. I suspect most of us wouldn't agree with that number.
But it's not a matter of whether 92 to 94% of executives are doing a good job, because you don't get to vote on that. You actually get to vote on proposals put to shareholders. So it's not a popularity contest or an assessment of people's whether you think they're doing a good job. There are proposals put to shareholders. We engage beforehand, we engage afterwards. And I actually think that a lot of active managers, I can think of having aggregated, as we all know, we have to disclose for funds, you have to disclose your proxy voting, and for your managers. And when I have aggregated active managers in the past, it's a very, very high percentage of voting with management. I don't see voting with management as a negative.
Okay, we can engage in that debate, but let's just go to the audience if we can. As a question over there, is it David?
Thanks, Sam. So Greg raised the sort of spectre of passive management sort of potentially leading to systemic issues. Now, I saw something the other day, I'm not sure who put it out, but they were talking about measures of the US equity market being overvalued, and they said, look, here's 30 different measures, and they said the market was overvalued on 28 of those. And I sort of look at that and go, what the hell is happening? And I'm wondering if it's, central banks are buying bonds or people, they're putting money into equities, an equity managers, as a rule, aren't sort of putting money into cash, are they? So they're putting money, whether they're passive or active, they're just buying another stock with that. And so I'm wondering if that's too narrow, this active sort of passive debate. If all the decision is always about what equity you buy, rather than if the overall market is too high. And like everyone thinks bond yields are going up. One in every 3 years they're right, it seems. So there'll be some sort of CIOs who wouldn't buy a bond, maybe, Sam. And so I'm wondering if in terms of in the markets are the active managers and the passive managers all just buying and not thinking enough about it, about the actual allocation?
Well, I don't think we can blame market sort of valuation distortions on either active or passive at that sort of aggregated level. And it really does actually, I suppose the follow-on point from that is that at the end of the day, none of us are actually, maybe with the exception of Warren Buffett, none of us can actually ever be truly passive investors. We all accumulate wealth over a period of time, and then we probably draw down on that wealth over a period of time. So we always have an active decision to be made every time a dollar comes in the door as to whether to invest that dollar or not invest that dollar, and in many cases where to invest that dollar into equities, bonds, cash, or anything else. So there is always an active decision to be made in aggregate, and to us again it would come back to how do you choose to implement some of the underlying decisions that you then make. And there's nothing wrong with components of that being cheaply passively invested. Our point would be to understand what it is you're buying and why you're buying it, and bearing in mind that the aggregate decision you're taking is in all cases an active one.
And that's the point I made about the most important decision is the asset allocation decision, and that is always active. The implementation of it is, you choose a framework and you choose a mix that's appropriate, but it's the asset allocation decision. And I do find a lot, in the last month I've been printing off any article about indexing active, and it often gets very confused that people throw in this about the market being overvalued. that's investors making a decision about whether they want to allocate to equities. The split of the pie within equities is a different decision than the asset allocation decision. I think it just muddies the water.
And I'd add, if you're going to be passive in your asset allocation decision, that is one I would be absolutely arguing against.
Okay, we've got some agreement by the sounds of it. Alan?
One of the things that's a necessary precondition for any of this is the existence of indices. And S&P Global is public stock. The FTSE indices are run by Russell, owned by Russell now. There was a report in the press earlier this year that BlackRock and Vanguard were considering bringing index construction in-house because it's a significant component of the cost, certainly in the USA. And S&P Global gets a revenue stream like an active fund manager as a percentage of assets under management. I'd just be interested in both of you commenting on that and when eventually we reach the point that the indexers mark their own homework.
Well, I think we're already partly in the case of the tail wagging the dog, and you only have to look at the way people do, sort of myriads of attribution analysis and et cetera, sort of quite detailed performance analytics over relatively short-term timeframes to understand that that's, all by definition, all of that has to be against an index, and the index is to some extent sort of an arbitrary construction in many cases, particularly around choices as to who's in and who's out, because they're not always strictly done on market cap. But the other data point I'd add to that is, and I saw this in another report just recently, there are now more indices in the US than there are stocks.
And as for the bringing it in-house, I could not envisage that ever happening. We have a lot of index expertise, clearly, and we do see ourselves as advocates for our clients with the index providers and with the exchanges, the stock exchanges, just to make sure the interests of clients are being reflected. But I think it's important to have that independently. It is true that the cost of them matters, because what's referred to in the US is the Vanguard effect, which is how we have managed to pull a lot of the industry down, the industry's fees down over the 40 years we've been operating. When you get down to a level where actually it is significant, the proportion, the fees you pay to index providers, but I cannot envisage this. We'd lose that independence.
So the only index that really matters for all of your clients is, can you generate a positive real rate of return?
Good.
For the risk you take.
We have 30 seconds left. David Hartley.
So Mary mentioned your favourite criticism of indexing, which was bringing down capitalism. But at some stage, imagine the wonderful world where indexes manage 99% of the assets. Does that bring any issues with respect to, say, allocation of capital and pricing discovery?
Yes. I've got 4 seconds.
Okay, in that ideal world where we're managing all your money for you, just trust us. But in the meantime, despite all the talk about the flows into indexing, in the US, the total of index trackers is about 15% of assets follow track indexes. It's only about 5% of trading activity. So there is still all that trading activity going on for price discovery. So I think we are a long way away from that.
Okay, we have...
I'd just add, my actual favourite was from a Sanford Bernstein report that I think was titled, "Is Indexing Like Marxism?"
Magnificent. We've gone slightly over time. We've had the better part of 18 or 20 questions. We've only got a handful of them through. It shows the interest in the audience in this topic. As I said earlier, I'm sure you'll agree that this was no ordinary active-passive debate, but the one that took me, the Greg's picture of no sour grapes is the one that I'm going to remember for a long time. And so as a gesture of goodwill, I'm going to ask both Greg and Mary to shake hands.